Welcome to another edition of Risk and Return. I'm Charlie Gasparino with my partner in crime, the great Bob Sloan of the S3 Partners, the daddy of data. And we got a great interview coming up that Bob did. And I'm not gonna give any spoilers there. Bob's gonna introduce the guest a little later, but first we're gonna get right to his his stock research, which again is the best in the business, particularly as it relates to short selling and where big institutions are placing their bets. And you'll learn about what's known as battleground stocks and what exactly that means after we get through this segment. Bob, take it away. What do you got going this week? What looks shorty?
Well, I'll tell you. First of all, we did a great. We have a great guest on with Tom Shapiro of GTIS. He covers everything you can possibly imagine on real estate. You're going to want to listen to that. We have two picks this week. One, we're bullish on. We have earnings coming up on Paychex. We're bullish on Paychex. We are bearish on Nike. Those are our two picks for the week. And you know, Charlie, we did something pretty interesting. We actually put together a bunch of baskets over the last 6 months, and we looked at stocks that are the most shorted. And the way we did it, we said, let's take those stocks that are more, and this is in the US now, just the US market, that have more than $10 million of short interest and a market cap over $300 million. If you went long this basket over the last 6 months, you would have made 48%.
Oh my God.
Okay. This is
why is that? I mean, that's kind of a riddle wrapped up in a kind of, what was that line from that Joe Pesci said in that JFK? A riddle wrapped up in
an enigma, right? Exactly, right. An enigma wrapped in a riddle, and so on. It's very simple. Position sizing really matters, and what's happening is that as people identify the fundamentals of why they want to short something, what happens is the technicals take over, and the market's an up tape, and there's a lot of different things that are adding fuel to the fire, and the shorts, it's very, 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 very hard to make money. So when we had Jim Chanos on one of our first interviews, he said, look at the most shorted stock index. People say you can't make money short selling. You made a ton of money. Well, that's reversed itself and more since that point in time.
Well, that begs the question: how's this MicroStrategy thing going?
Well, we should have him back on and ask. He's pretty active. He's pretty active on Twitter.
We will.
And I get a kick out of it because a lot of things you and I spoke about, which is the leverage and what people are trying to do there, and all the treasury coin and so on and so forth. I know the treasury company, digital treasury companies are trying to they're trying to fund. It all started on our show. So that's one thing, the most shorted basket. Now, if you went long a basket of battleground stocks that were, and there are about 90 of those where the long and short's about equal, that actually is up about 64%.
Okay, that's interesting.
Interesting. And if you actually were short those stocks that are short bias, so the way we look at it, we say if the short position is about a third more than the long, so about 0.65.
If you call it shorty.
It's shorty, right? If the short bias basket, if you shorted that, actually you made 100%.
Oh my God.
About 95%, just about 100%. So it's fascinating to us is you're long the most shorted stocks, you made a lot of money. If you were long battleground stocks, you made a lot of money. And if you were short those stocks where the short selling is more than the active long position, you made an absolute killing.
Any insight into why that is? I mean, it's
flow of funds,
statistical sort of fluke of what.
Yeah, well, but flows matter, right? And so what we're showing people is that when you get almost equal short and long, if it's skewing short, it's going to go short. If it's skewing long, it's probably going to go long.
And that's battleground stocks are generally skewing long, right? More or less.
Yeah, I mean, but for sure. But there's way more skewing long than skewing short. So that matters. And that technical nature, as long as it lasts, and it will last for a long time, we believe, because indexing is a thing and ETF is a thing. It's part of the market structure and the way we live. That is, we thought, a really, really interesting.
Well, there's a tip for everybody out there. Follow those battleground stocks
Follow them and
follow
use
the
that data.
shortish stuff.
Absolutely. Then there's another stock, which I think we're going to pull up, which is Dongfang out of Hong Kong.
I don't
And
know how you found that company, but
it's an interest. No, this isn't interesting. This is a really interesting thing. It shows you that retail is still very much alive. So a lot of the speculation, and a lot, Charlie, you asked a really interesting question. Hey, why is this happening? Well, I happen to think not only is position sizing and the technical matters, but think about it. Poly market is a thing. Kalshi is a thing. Speculation now is a sports betting, huge thing. Speculation is really part of an everyday life experience.
it really is. And for a lot of reasons, aside from it's easy, people think they can get ahead of inflation by speculating.
By speculating.
Sometimes they can, sometimes they can't, but
right.
That's
but that doesn't mean crazy anomalies don't exist. So this company listed more shares, and you did so much reporting on us with the ape shares, all the dilution that went on. So the company goes out and issues shares. And what happens? You'd figure the stock would fall. The stock rose through the roof. So short sellers went in, arbed that. Now the stock price is down. You still have short interest pretty high. And, we're saying, hey, you know what? Maybe this stock is somewhat squeezable because the shorts are still in the stock. It's a turbine company. It's a power structure company. It has a pretty high market cap. And, it's an interesting thing that these anomalies still exist, even after all these things that we went through with the meme stock. You still see companies issuing and the stock flying higher. Short sellers come in and arb it out.
Is this a meme stock? I've never heard of this company, so what do I know?
Well, it's meme stock like in that it has a following. It is, everything power related, and we talked about this. How people going long power stocks because there's so much the electrical grid is so needed for AI that the company comes out and says we need capital. Usually that's dilutive and stock price fall. In this case, stock went berserk, and the short sellers came in and increased their position. So those things still happen. The next thing we want to talk about is E&I, which I think is a really interesting thing. Now, the last show we talked about France. Right. And how that might be a precursor for weakness in Europe. There's a lot of things going on in Europe where there's an economic slowdown. Now, E&I is the biggest short position in the Eurostoxx index. Now, E&I
is the company from France?
No, it's an Italian. This is why it's interesting. It's an Italian oil and gas producer. It's an energy company. It's the single largest short in the Eurostoxx by notional with about $3.8 billion, 10.8% of float. The short inch is up 260%.
That's amazing. That we're now, you would think you need energy in Italy, right, for something.
Well, unless you think there's an economic slowdown and you think the price of oil is too high, which affects the stock.
Yes.
Right. So this is why we are saying, look at this, even though the price is up 13% year to date, shorts have surged from 3% of the float to nearly 11%. It is crowded, and it's scoring kind of squeezy. We look at about 70. But it's interesting that they're hanging in there, and you see such an increase in short position in this stock. So what does that say about Europe? You have increase now in France, followed by it's the biggest notional short in the Eurostoxx, which is kind of like the S&P for Europe. Probably that is foreshadowing economic weakness across Europe. And lastly, look at the inflows of the VIX. This is fascinating. We've taken a look at the VIX index, and the inflows into the VIX, which is about 17 right now, has gone from I think it's $7 billion to $28 billion. Oh
my God.
So people are really getting long volatility. They think it's cheap. And
which says that rate cuts blow up the market because we still haven't hit our inflation target, and
Unknown risk, unknown risk, and there's just so many geopolitical events going on.
we did have a good GDP print, didn't we?
We did. And so, but people are long volatility. It just means that they think that the VIX is cheap at about 17. Don't forget back when the tariffs were announced, it was about 45 or 50.
Right.
And saying, hey, the market is too docile given what's happening in the world. And so we looked at those inflows. We thought that was good data. Lots going on in the marketplaces, but as we said, paychecks negative, Nike positive. Take a look at the battleground stocks. Take a look at those short baskets, and to take a look at ENI and some of the power companies in Hong Kong, Dongfang, and people are long volatility. They expect an explosion.
Up or down, you think?
Up. They're long volatility. You want it to go from 15 to 50. They think there's another shoe to drop that will jar the market. That's what that says.
Higher.
Higher, yes.
Woo.
Volatility higher, which means, maybe market lower, right? Fear.
Oh, okay. That's what I meant. That's what I meant.
Yeah. Meaning that they're long fear. That's what
what's fascinating about this is because just sort of the underlying premise is like everything is rosy. We got 4% growth now, and markets are at highs, and they keep going up, and the Trump tax cuts, and yet there is still this sort of lingering worry that the tariffs haven't really hit yet. Inflation hasn't really been tamed.
That's right.
I mean, these are just macroeconomic things that obviously are eating at the data, some of the data that you're coming up with.
Absolutely right. Charlie, what do you got for us?
What do I got? Someone asked me that once, and I got in trouble on air when I was at CNBC. You can go back and Google it, but we won't go there. But a couple of things. By the way, I did see your pal Gavin Newsom 2 nights ago at Ilios with his lovely wife. I was this close to breaking his chops for that very nasty comment he made about a story I did. And I know the owners of Ilios, so I'm like, just leave him alone. My brother was sitting next to me. My brother is kind of a respected guy, doctor, PhD, MD.
Unbelievably respected guy, and he really does good work.
He does. He saves people lives. He runs the ICU at Brooklyn Hospital. He's the chairman of medicine there. But he goes, say something to him. I'm like, when I saw him with his wife, I said, let him go. But that was one thing. But the real news that we have is that the continuing controversy. I've been spending a lot of time on this, like nonstop on Jimmy Kimmel, what's going on there. I mean, it sounds like just a very narrow story about Jimmy Kimmel, right? Saying something really nasty, basically blaming the assassination on Charlie Kirk on the MAGA crowd. That's essentially what he did.
Yeah.
ABC threw him off the air for a couple of days, and then reinstated him. And so far, as of today, 2 major affiliates run by Nexstar Communications and Sinclair Media Group have suspending him. They cover I would say like a quarter of, maybe a little less than a quarter of all ABC affiliates nationwide. So this is a big chunk of change. From what I understand, that they're going to face enormous pressure from Disney and its CEO. Disney is the parent company of ABC, to reinstate Kimmel, despite what he said was so bad, and even if their audience doesn't like it, which this is a middle American audience, they don't. And one of the reasons why is the affiliate agreements that they've signed with Disney. It's hard to break those. I mean, you need real. I think you see it rarely. I think back in 2018, Roseanne Barr, her show, Roseanne was throttled a little bit because she said something racist or allegedly racist. Kimmel kind of apologized, and that's what got him back on ABC. It wasn't really an apology, but it was like a statement of contrition, let's say.
Right. Well,
I'm laughing because it was so pathetic. I'm not laughing at what he said. What he said about Charlie Kirk was really nasty and stupid. And so they're going to be forced by Disney to go back on the air. But, Trump wants this guy fired, and he's going to put pressure on, I believe, Disney and Nexstar, Nexstar has a deal to buy Tegna, another media company.
That's right.
And they need FCC approval. So this could get really nasty. And as you know, Disney has a deal that needs FCC approval, Trump approval, to buy the NFL network. So this could get really nasty really fast. So,
well, that's an all cash deal. It's not a stock deal. And when we've been tracking,
which one? The Tegna deal?
Yeah, the Tegna deal. And we've seen that the short interest in Tegna has gone up almost double.
Yeah,
which is
because people
interesting,
are
right?
betting this might not happen, I
Might
think.
not happen, right? And so the next door short interest more or less stayed the same. Warner Brothers, which obviously also people thought, oh well, everything that the Ellisons are doing in terms of trying to reform, their not reform, but add to their media acquisitions. The Warner Brothers short interest ran away. It just fell right out of bed, and people covered their shorts immediately because they thought Warner Bros. Was a target.
Well, they are a target. What's interesting about Warner Brothers, though, and there's another story I broke, is that Zaslav, no one has approached Zaslav as of today, as I'm talking to you. There has been no. Now, this could happen the minute we go live.
Right, no, sure. It's a very volatile
But
situation. Absolutely.
nobody has spoken with Zaslav, who runs Warner Brothers. So that means Ellison hasn't officially made the approach. And this is like a month after this thing first leaked, which I reported and the Journal reported. And we do know that Zaslav is shopping the company. He hired Goldman Sachs to shop. And they're talking to Netflix, they're talking to Amazon, from what I understand. So I think the reason why the short interest really covered on Warner Brothers is because either way, people believe it's going to get sold. Either he's going to have to sell to Ellison at some
Yeah.
point,
Yeah.
or he's going to sell to Netflix. And they're breaking up the company. He's saying that even on a breakup, like say they just like so. CNBC put out a story that said that for the whole thing, they Ellison might bid $24 a share. I can tell you, Zaslav is telling people they can get, I want at least 30 for just the streaming part and the studio. So, they're this I can see why the short interest capitulated on this. It's actually a fascinating story. And I keep watching this. And again, this is day to day, minute by minute. Just keep watching your screen. That's it for me today. I mean, I'm storied out with Kimmel. I can't even tell you how many stories I've done on Jimmy Kimmel. I don't watch Jimmy Kimmel, but for the last week, I've been writing about him literally twice a day.
Well, I got to tell you, your distinction between cable and what's on public airways, and that was so crystallized just reading,
Right.
your stuff on X, which I do obviously religiously. That really framed it for me.
Well, let's go through that just before in the last few minutes we have here, we just take 2 minutes. People are getting on Brendan Carr's case. He's the FCC chair because they say he's adding politics to the media business. They're saying that he's trying to force these various media companies to go right wing, or he'll throttle their deals, he'll remove their licenses, he'll do this. Um, Here's what Brendan Carr is doing. Now, we should point out that his power only can be exerted on free TV. Okay,
Right.
when Congress created when Congress passed and the president, and I guess it was Roosevelt, signed the Communications Act of 1934, it was over these airwaves. They had to serve the public interest, and that's why for so many years you really didn't see overtly political stuff on air. It was like the Huntley Brinkley report, right?
Right.
That changed recently, and he's saying like, listen, why should ABC just run like constant news programs and quote unquote entertainment programs that's purely anti-Trump. That violates the public interest. And I think he's got a point. The other point is, I will tell you, I'm going to address this in a New York Post article. During the Obama years, they did some of the same things. So did Biden. I mean,
Sure.
he's not the only one.
Sure. No, I mean, listen, Trump was thrown off Twitter. And
And by the way, that's not
all the
even.
things with Google that Biden did, but both sides try to influence. I mean,
And by the way, that's even worse because there's the regulatory authority is very nebulous on that. That's just like we're just going to investigate the shit out of you if you don't throw Trump off Twitter. That's what basically that is. This is like the FC really does over free TV, not cable, have this ability to say, we need fairness, both sides. That's what. By the way, you and I don't have to do that. We do it anyway.
Well, that's true. That's what makes this show great.
I agree. Well, that's it for us. That's it for now. Bob is going to have a great guest, and I'll let him take it from here.
Charlie, thank you. We would love to welcome our next guest, Tom Shapiro. Tom is the president and founder and CIO of GTIS Partners, a global real estate investment firm that manages $4.7 billion in gross assets with a focus on residential and industrial investments. He is responsible for overseeing all investment activity and strategy for the firm. He began his career at Tishman Speyer, where he was a senior managing director, and then eventually member of the firm's investment and management committees. And he also serves on advisory board, an ethics advisory board for the Wharton School at the University of Pennsylvania, where he graduated magna cum laude. Tom, welcome to Risk and Return. It's great to have you.
Bob, thanks so much for having me. Really appreciate it. I'm looking forward to this.
Yeah, no, we're going to have some fun. One of the things I think when people hear the housing market, you always hear this on the news, particularly on some of the news channels and so on. This is the housing market as if it's something of a monolith. And I think what our conversations, at least prior to getting on the show, is that it's really a segmented business, right? You can't look at it as just one particular overarching segment. There's a lot of nuance to it. So if you wouldn't mind just walking us through what the segments are, and then talk about what your role is at the firm. What is exactly a private equity real estate space, and how do you specialize in each segment?
Sure, thanks. We really appreciate it, Bob. So let's start from the top. Residential real estate is a housing unit, and it can be a lot of different things. So it could be an actual house. That's what most people think. It obviously could be an apartment. It could be a mobile home park. It could be a lot of different things. So when we think about the business, we start with there's a consumer, and that customer is someone who is about to create a housing household, and they're going to move out, normally maybe out from their parents' basement or graduating school, and they're going to want to now create a housing unit. And I think the way we think about it is, what is it that they're going to do? What's their lifestyle decision? Are they younger and they want the urban environment with the bars and the restaurants? Are they older and they're going to now move out? And I think people make a lifestyle decision first about what is it that they want, and then they make a financial decision of whether they're going to rent or whether they're going to actually own that. So, to answer your next question is, what is private equity real estate? Is we figure out ways of investing across the spectrum. And of course, things change over time. So I'll go back to the global financial crisis. So what happened there and why we ended up there was we were producing over 2 million housing units a year, which was way too much. And here's why. We generally create 1.2 million households a year. And that's a number that's over the last 45 years or so. Sometimes it's more, sometimes it's less, but it runs about that. And so if you have 1.2 million households, someone needs actually a housing unit, and you're producing 2 million, of course, at some point you're going to get oversupplied. So we know the story of the taxi driver owning 4 different houses, and everybody went out and everyone was complicit because everyone got mortgages, and Wall Street was complicit, and of course the mortgage brokers were complicit, and the brokers because they wanted to sell homes. So everyone was sort of complicit in this, and the market got extremely oversupplied. And that's why we ended up with the global financial crisis, because frankly, the housing market just collapsed under the weight. So how we got into the business to invest is, particularly in this sector of the housing market, is at that time, people thought there would be 7 or 8 million foreclosures. But when you really think about it, is people aren't going to walk away from their house if it's slightly under market, meaning their mortgage is worth more than the house, because it's their house, they live in it. It's not just a financial investment. So when we really looked at the statistics, we felt like it wasn't going to be nearly as many foreclosures as people would think. And once the economy recovered, again, getting back to the basement analogy, kids who are living in their parents' basements are going to move out. That's the first thing they're going to do when they get a job. So we figured household formations, which dropped, and housing production dropped to like 600,000. Formations dropped because people were doubling, tripling up and living in the basements. We felt like as soon as people got jobs, that was the first thing we're going to do is go back to household formations. And so we felt that whatever that oversupply would largely go away over time. So our big, everyone, I'm sure a lot knows about The Big Short. Everyone's seen the movie. And that we just tried to figure at the time, maybe it hadn't existed, but we figured like what's the best way to play the housing market at that time. And we figured the best way was really to go after land. And so we had all this land, which was really toxic waste at that point, because you had land that was just fallow, you had land that was partially developed. What happens is you put in the roads and the infrastructure, and then the home builders put up the homes on it. So you had a lot of this land that was kind of ready for production, but there was no demand. So it really went to nothing, because if you think about it, if it costs $250,000 to build a house, is worth $200,000. The land really doesn't have a lot of value. But of course, once the housing market recovers and homes are $300,000 or $350,000 or $400,000, the land, a lot of the residual costs go down to the land. So land dropped about 95% in value. And so we bought about $1 billion of land back then. We bought a company called Town and Country with our partner Hovnanian Homes. We bought a lot of land. We bought, for example, in Phoenix, a site that was going to be bought for $125,000 an acre prior to the GFC, and we bought it for $6,000 an acre. And so that's kind of how we got into it. And so we really invest across the entire spectrum. We do rental housing, both multifamily. We have a very large project in Miami with our partners Related, called the Viceroy and Baccarat, and that's a $1.6 billion project, to everything from, and we do these build to rent communities, which are really horizontal multifamily. So we invest in a lot of multifamily. We invest in a lot of for sale. We think of it sort of a wholesale to retail strategy, where we buy land, we put in the infrastructure, we sell the lots to the home builders. So, and we also invest in conjunction with some of our home building partners. We actually invest in the actual production of homes as well. So we do invest across everything, but it is a big spectrum between for sale and for rent, and of course the unit types of apartments, mobile homes, as well as apartments and actual housing units as well, actual houses.
Yeah. So in the last 15 years, the opportunity set has gone from multi-tenant, let's say commercial. Now you have data center, industrial. Walk us through that. Walk us through what the opportunity set is today from your perspective. And one of the things that's interesting, at least for me, I think, what's dominating the headlines today? AI, tariffs, rates, housing stock. Interesting thing, I saw a stat the other day about home ownership over time for 30-year-olds and how that's dropped, and how seniors really own most of the housing stock. So walk us just through multi-tenant. As you buy the land, you develop the land, you went to multi-tenant, how that's either maybe topped out or the opportunity set is less. All of a sudden people are saying, what's commercial real estate going to do? Now you have AI and everybody's doing a data center deal. Walk us through what you see.
Sure. So let's go back a little bit. One of the best investments was a pretty simple one, was just to buy multifamily. You'd buy in a good location, but a little tired property. I like to say, put lipstick on the pig. You put in the quartzite countertops and fix up the kitchen and the stainless appliances, and you make a 20% return. But the truth is that, and because you were value adding, but the truth is that's not why you made the return. You made the return because rents went up and interest rates dropped. And the problem is that, there was just a lot of free capital. And so in a lot of the really good markets, particularly the Sun Belt, where a lot of people were playing, people started to build, and that created a tremendous oversupply. So if you look at a market like in Austin or Nashville or Charlotte, Austin, for example, was the best multifamily market in the country. It's now the worst. And that's mainly because, it's not because all the jobs left and people left Austin. It's got a lot to do with the fact that you just were too many units produced. So I think that, I went around, I mentioned to you, when we spoke before, that I went to Phoenix 18 months ago, and everybody there said, we got about an 18-month, two-year supply issue. So you go back today, they're going to say the same thing. So it is taking longer to absorb these units. So I'd say the best strategy had been invest in the Sun Belt, buy multifamily, sit on it, It's great. And AI and all that, it's got obviously people still, and the people aren't going to live in a data center. They actually have to live in a housing unit. So obviously isn't affected in that way by it. Maybe some material and cost of building and things like that. Architectural plans and engineering plans maybe get cheaper, but that's the truth. So it's very hard right now, in particular on the development side, to build because the starts now are way down, but it's going to take some time to absorb that. So the coasts are doing much, much better. New York and San Francisco. So if I take San Francisco, for example, the issue with San Francisco is all the tech companies said work from anywhere. And so what that caused is everybody left. And so instead of being in a 1-bedroom or studio apartment in San Francisco, you can be in a 3-bedroom house on a golf course in Phoenix. And that's what people did. So people left the city. And then of course it had a lot of social policy issues there. Where you had homeless mental health crisis, and it was really, the city really is very sad. I actually lived there for a few years, and it was very sad to see what happened to San Francisco. So rents dropped 30%. Properties that were built went down 50% in price. There's rent control there, so it became a very tough place. Now I'm very bullish on San Francisco right now because everything's sort of turned around. And to take your AI example, AI, that's the epicenter of AI, is a lot of AI jobs that have been created there. Obviously, very high paying. You have the tech companies now have told people get back to the office, and so people are starting to move back to San Francisco. And Lurie, the new mayor, has done an incredible job sort of cleaning up, all the social issues and the mental health and everything else that they've kind of been working on to really try to fix the city's issues. So that, and I'd say New York has been a big beneficiary too, because everyone's back to the office. You see that you live here too, like you see the vibrancy, what's happening in New York, and that also, rents are going up and up and up, and it's very, very hard. In fact, it's almost impossible to build larger buildings here because the incentive programs that existed to create affordable housing kind of went away, and so that's been tougher. So the opportunity set, so it went from just, hey, buy any multifamily building in the Sun Belt and okay, have a story for value add, but rents are going to go up, cap rates went down with interest rates going down. And so, you went, that's really where you made your money, not on sort of fixing it up. To now, I think it's more interesting to buy existing in a couple of these markets like San Francisco or New York. And eventually we'll get back to development, but that's going to be some little bit of time before we see a lot of multifamily development. We like the industrial sector. Obviously it's been affected. You pointed out tariffs have been a big issue. And the vacancy rates have been climbing, although still, under 10%, which is reasonably healthy. Not terrific for industrial, but we definitely see the leasing market starting to pick up. It had been very slow and the starts are way off. And we do think, given all the onshoring and, e-commerce, continuing to climb. And of course, you mentioned data centers, like you're going to need more industrial and warehouse space and distribution. So we actually like that sector, and I think it's more of a rifle shot, not a shotgun shot. So we're being very specific in the markets that we're doing that in, but we are picking up a bunch of land positions right now to get ready for some selective development in that sector. AI has been the hottest sector right now, of course. A lot of it has to do with power. You have to actually have the power in order to actually build the data center and the water. So that's been a big issue for a lot of places, but data center, obviously the demand seems to be nonstop at this point. So, but with a lot of these sectors, they do end up again getting oversupplied. There was a huge rush to do life sciences. That's been a complete disaster, got way oversupplied. I always thought that was not such an interesting business because you really were taking venture risk for a lot of these life science companies. And only getting paid real estate returns for it, because if they worked out, they paid you the rent. If it didn't work out, you got the space back, and oftentimes you greatly fitted out the space. So it was not, to me, never a great sector, and everybody sort of piled into it. So I do think you have to be careful of these newer sectors, but obviously AI just seems to have incredible tailwinds right now.
So when you're looking at and thank you for that. That was a really wide swath.
I tried to cover it quickly.
We covered a lot of ground there, but one of the things, obviously S3 is in the data business. We supply alternative data to investment management. When you're looking at industrial space, et cetera, you're looking at the demographics of the San Francisco versus, let's say, New York or other cities. When you're in an investment committee, what data is important to you? what are the things you're looking for that captures that swing when you say, okay, San Francisco's on a rebound, things are swinging in our way, this is why we like the opportunity set? Are there certain data sets, a data point or data points that you look at when you're making your decision? You say, yeah, this is what we need as a key point for our decision-making process.
Well, we like to say we follow the jobs, and I think that's been a pretty good tenet for us that we've been following up for a long time, because trying to go after a market that has seen outflow of jobs is really, really difficult. And then, as I mentioned, we really look at the supply picture of what's actually happening in the market. And a lot of these too are these micro markets. So you can't just take a broad brush over a lot of these markets to sort of figure it out. And then some things work better than others. Like there are markets where we never develop multifamily, but we would do industrial. So I'd say, job growth, and also frankly the politics in some of these markets too, because you want to be in pretty business friendly environments, because who wants to be in a house that you're not welcome in. So we do try to like pick the areas where people are welcome. The issue with what I just said is a lot of people are following the same data sets, and so that's when you end up getting oversupplied. So you have to figure, it's not like developers tend to collude on, hey, we should build 5,000 housing units a year, so you go this year and we'll go next year. What tends to happen is everyone builds it at the same time. And these are long delivery projects. Industrial is a little bit lower. We can build an industrial building in 9 months, but I mean, we have some of our projects take 3 or 4 years to deliver, these larger, 50, 60, 70 story buildings. And so you're really projecting what's going to happen in several years from now. The issue with condo, of course, is you got kind of one shot to do it. You have to like sell it through and deliver it at a certain time. Multifamily, as long as you can hold on to the building, even if you open up in a softer market where it has, like, let's say, higher vacancy, as long as you're not over leveraged, at some point, if you made the right bet on the market that you believe there's going to be job growth, that you'll actually see that your income will kind of increase. And one of the things that and I mentioned before, which we really, really like, is student housing, especially around the SEC schools. We've seen, actually, I was just in a meeting, we just went through one of our projects that we're launching. We're seeing 8% growth over what we underwrote, and we're seeing in another project around 9% year over year increase in rents. So those markets are more supply constrained. You have to be right around the university, so it does have higher barriers to entry. And particularly if you pick the right schools. Now, some schools are just dying. Some of the smaller schools, sadly, are going away to the benefit of some of the larger schools. And so we're focusing on a bunch of deals. We just did a deal in Ole Miss. We just did a deal in Auburn. We built a project at the University of Maryland. And those are seeing really, really good opportunities there. And we do focus a lot on opportunity zones. And interestingly, because of the tax benefits of that, and interestingly, a lot of the student housing, of course, is in our opportunity zones because the incomes aren't there because they're students.
Right.
So like really good places around like USC and the schools I just mentioned really are all actually end up being located in opportunity zones. So they're great areas that you can build in and take advantage of the tax program.
Yeah, no, football is an incredibly powerful force when you think about the tangential elements and how it spreads and how that it's incredible, really.
It is, and that's why they're paying the athletes now.
Exactly. So let's talk about New York City. It's our home.
Sure, let's go for it.
Let's go for it. So what if you were to advise a mayoral candidate on what to do, what is proper housing policy, and you hear affordability as a campaign issue, but talk about that versus what would you do to increase supply, or how do we increase supply, or do you need to increase supply?
Sure.
How do you make market forces work versus just having some kind of mandate that freezes things, and we know pretty well how that might work out.
So like, affordable housing is an incredibly important topic, and we can't just have finance and tech people in New York City. I mean, we need support. We obviously need nurses, and we need, I hate to say doctors, and we need policemen and firemen, and we need service workers to work in, people need to be at Starbucks. So I think it's just an incredibly important issue, and it's one that's really near to me, and something I really hope that we can work with the mayor to figure out a better program. So for a long time, there was a program called 421A. 421A required originally 20%, then it was 30% of units to be affordable. And the program kind of worked. And the deal you got at one point you were able to get these low floater bonds that sort of went away, but what you got was a 30 or 40-year tax break. So you basically didn't pay property taxes. And that was exchanged for the units, and it actually worked. And there were thousands and thousands of affordable units that were created through this program. As we also know, the rules for existing also changed. And even at one point, they didn't allow any increases. But the issue with doing that, of course, it's easy to say, oh, the big bad landlord, they're raising the rents, and so they shouldn't raise the rents. And we have these, we can actually control the rent stabilized units. We can actually tell them how many units that they, what the increases they can have on their apartments. The problem with that is that if you tell a landlord they can't increase their rents, there's a couple issues with that. One, it's not like the city's then saying, oh, we're going to give you a break on your property taxes. We're still going to increase your property taxes. Your operating expenses are going to go up, and so your margins are going to go down. What ended up happening, of course, at the same time, the interest rates went soaring, and all these properties ended up going back to the bank. So everyone was in foreclosure, everyone lost the apartments. And what you need is people to actually invest in these. And you used to be able to pass through your capital expenditures, and that's extremely limited at this point. So you end up having a lot of units that are just vacant that nobody wants to put money in. Because the issue is that if you have a building where you're getting $1,500 rents and the market's $5,000 a month, you're going to rent that apartment no matter what the building looks like. So you have no incentive to put capital in. So we need a better program. And they came out with this thing called 485X, which was the new 421A. So under 100 units, you can build without any wage requirements, but then there are wage requirements at 100, and then there's another break above that. And starting at $40 an hour minimum wage into I think it's like $65 an hour. And it's just not economical. I mean, we ran the numbers, you just can't build. So the only thing you can build is under 100 unit buildings. And at 30%, that means 30 units you're only producing, as opposed to you're building a 400 or 500 unit building,
Sure.
20, 150 units at a time. So it's really going to slow down. Unfortunately, everybody piled on to what was in the program without listening to the real estate industry. And I know everyone just thinks that there's just so much profit in these things, but you can actually see that people aren't building it. If it was profitable, believe me, developers
They would
build it. So they're not building it. So you can see what happens. So we really need to fix the issues. I think we need to fix the issues for the existing units. You can't. It's not good that we have all these vacant, basically rent stabilized units or rent controlled units. It doesn't make any sense. Like, why do that? We have to find a way to incentivize developers to build units, but also to basically put capital into buildings that are existing as well. And look, I think it's not just the real estate industry's problem, it's a general problem for New York City. So whether we tax everybody or create something, I'm not particularly for keep increasing taxes, but at some point, somebody needs to pay for this other than the real estate industry if we really want to have a vibrant city and not just have finance and tech people who can afford rents to live in New York City. So we need to work on that. It's an incredibly important issue. And we really need to create a lot more affordable housing units. So I agree with every candidate that we have to create it, but we have to find a way to do it that actually financially is viable for people to actually build these units.
And one of the things too that I a little bit laugh at is that some of the campaign, particularly Mondani, has said, oh, everybody can afford an extra 2%. But that's not the point. The point is you're adding on 2%. It's the spread in total taxes. Yeah, yep. If you operate a business, which you do in New York City, you pay 3 or 4% right off the top. So now all of a sudden it's 20%.
Yep.
In total. 20% of anybody's income invested in something else other than city government or state government. That's a real thing. So it's not the 2%. You're getting to that marginal point where people just go, at 20%, I can't do this anymore. And I just wish someone would say something a little more logical than just say 2%.
I mean, you're absolutely right. I mean, look, obviously, unlike federal tax, people can leave New York City, and people did leave New York City. I mean, sure. If you run a private equity firm or hedge fund, it's not hard to actually relocate to Florida, assuming you want to live there. But I do think it's a little bit of what do you get for your money? And I think the death for New York City will be higher taxes and higher crime. Because if that happens and people feel unsafe to live here, I mean, I'm a city kid, so I actually grew up in Manhattan, and I lived through the 70s when it was, I mean, I went to high school up in the Bronx. Like I took the subway up there all the time. It was dangerous. We got mugged. I mean, it was not a great place to live. Most people didn't raise their families in New York City back then. I can't explain why my parents decided to do it, but they did. And so
Mine did too. So I probably
okay,
did the
so
same
good.
train
Yeah.
you did. So there you go.
They went through to the same thing. We count how many times we do a bake off of who got mugged more. But so that would be a huge problem. I mean, I agree. Like, and look, obviously, Mandani can't just raise taxes. Needs to Huckle or whoever to actually approve it. But I think that crime to me is the bigger issue, and quality of life, mental health. Like if we start looking like San Francisco was a couple years ago, that's going to be a problem. And that to me, that combination is very toxic and will cause a real problem in the city. So I really hope we don't go back to the bad days of when you and I grew up here. So
Yeah, I totally agree. And, Charlie, my partner on this show, and George Will are like, well, let them have their 4-year experiment. And I yelled at Charlie on the show and told him I think that's the most idiotic idea ever. You can't just say, okay, 4 years with an experimental government, and then all of a sudden after 4 years you're gonna undo all the damage. You're talking decades. And it's just, the city is such a complex organism. It has its own hospital system, it has everything. And just to manage that is so difficult.
for sure. I mean, and look, people leave, they're not coming back.
Yeah.
It's not like people are gonna, go to Miami or Palm Beach and then like, oh, New York's okay again, and they're gonna like move their businesses back when they're now used to paying no state, no city tax, and they homesteaded their homes, so their property taxes aren't so bad. So it's not gonna happen. So yeah, I agree. I mean, that's what we have to watch out for. And I think, well, of course, I don't want to pay any more taxes, and I agree with you. It's a terrible idea. I'm much more focused on the safety, on mental health issues here, homeless problem. Like, obviously, those issues to me are much more important, because that will be the end of, New York always comes back, but that will be a problem for a long time for New York. And we don't want to go back to, where we were in the 70s, which was New York was basically bankrupt. So
Tom, it's great having you on. Thank you we covered so much ground. Everybody, Tom Shapiro of GTIS, thank you so much for being on Risk and Return.
great. Thanks so much for having me.
Wow, that was pretty wild. Great interview, Bob. I mean, I think you got a future in this business called podcasting.
Well, you were trying to convince me for the last year. I should have listened to you a long time ago.
Yeah, no, it was good
Tom is
stuff.
a great guest. I mean, he covered everything. He covered
Right.
multi-tenant housing, industrial housing, data centers, policy in New York City.
Oh,
Our election was fantastic.
I don't tell you what to ask him, but I should have asked you, like, can you ask him how my house and my condo in Connecticut is going to fare if Mondami gets elected in the city?
Well, we can't leave air without a Mondami update. One tidbit, and then we're going to sign off.
He's still leading the polls.
Yeah.
And it's scary, and it's getting late in the game. He's going to be the next mayor. I mean, I don't know how you stop that. I mean, we're going to have a socialist communist mayor in New York City because Andrew Cuomo is running a pretty lackluster campaign, and Curtis Sliwa just can't make the sale, and Eric Adams is kind of hovering at like 8%, but he's not getting out. So we have dark days ahead. But here's the thing, and I've always said this, Bob. I have no problem with us hitting rock bottom, because if we do, it'll convince people just how bad socialism is and stop playing around the edges with it. I
just hope the people that leave because of it come back, and that's not a sure bet. That's
definitely not a sure bet.
I'll be sure bet.
I'll be decamped in Connecticut, but you never know. I might go down to Florida. I can do this show. I can do Risk and Return.
We can do it anywhere, and that's the point. Charlie, you're the best.
We'll see you next week, Bob.
All right.